I want to welcome, we have a new member to the board. It's Shirley Finca. Welcome, Shirley. Yay. Thank you for Shirley is a resident who is volunteering her time to be on our pension board, so we appreciate it very, very much. The rest of us, it's kind of mandatory.
I'm appointed.
I know. Everybody else goes, we don't want to give it to Commissioner Williams.
16 years, nobody will take this job.
I don't know why. We've got great interest here. Pam, if you could do the roll call, please.
Okay, Patricia Graypot,
Here.
Dennis Small,
Here.
Commissioner Williams,
Here.
Shirley Fink,
Here.
and Bill.
Public comment? You're the one and only? Okay, consent agenda, approval of minutes. We have the quarterly meeting minutes from November 16th, 2023. Approval of expenses. We had Burgess Chambers 2 invoices, Sterling Capital 1 invoice, Truist 2 invoices, and 1 retiree, Alec Robinson. If I could please get a motion to approve the consent agenda.
I move to approve the consent agenda and include the item that wasn't on the consent agenda to accept Alec Robinson as a retiree.
And a second?
Second.
Thank you. So moved. Old business, none. New business. Presentation from Blake Mighton, Sterling Capital, our quarterly report.
Yes, good afternoon. We'll be reviewing the fourth quarter. Very, very strong period for the markets for both stocks and bonds. But before I get into that, let me just back up a little bit and talk about, I want to share with you guys some pretty important news. About a week and a half ago, Truist Financial announced that they are selling Sterling Capital to Guardian Group for $70 million. They anticipate that the deal should close later this year. Really excited about the opportunity to get completely away from the bank. Recall, as we were talking over the last couple of years, as SunTrust and BB&T merged into Truist, I was really excited to, under the new Truist, to move back to the institutional investment management side with Sterling Capital, which was the BB&T subsidiary. This is sort of one more step further in that direction in kind of getting away from the bank thinking and ideology and their control over how we manage money and how we take care of our clients. So to give you a little background on Guardian, they're a global institutional investment manager. They've got offices in Canada, United States, and London. They have indicated that they are going to leave Sterling alone and run us as a complete wholly owned subsidiary. So 100% of the employees, the portfolio managers, the traders, ops people, client service, everybody that currently works for Sterling is involved in the deal and the transaction. So we're pretty excited about that too, because we know Truist could have certainly found some other partners where that may not have been the case, which has happened in some other mergers with investment management industry. So pretty excited about that. What it really means, I think, for my clients, which are mostly Florida municipal pension plans, such as yourself, is it really should be a non-event. Because we went through so much time and effort to kind of update all the documentation and paperwork with the Truist merger, that really it's as simple as it's probably going to be a one-page consent of authorization, transferring investment management authority from Truist over to Guardian. We're going to work with your lawyers at Harrison and Triggerman and Tuscan and Ken and his group to make sure that he's comfortable with all of that language, but that's what we anticipate. So we're really looking forward to kind of a very smooth transition.
So we'll be completely separate from Truist?
Yes, from on the investment management side. Truist will still be the custodian and the administrator for the plans, just as they are today. They'll still handle all the pension payments.
So that
But the
Truist will
investment
still
side-
send out the pension. Once you retire, you'll still get your funds from your pension, your disbursement every month from Truist.
So Ben would have still had to retire?
Correct. Yeah, correct.
So, Skip, it really should be business as usual. Again, because we really kind of, as we updated all the documentation with the Truist merger, we kind of separated the administrative functions with Truist investment functions with Sterling, and all the documentation says that, so it should be very, very seamless.
Blake, don't try to gloat too much over this last quarter, okay?
It wasn't all great, just 99% of it. It really, if I'm gonna sit up here and take all the blame for 2022, I'm sure gonna gloat at least a little bit this year. No, I tease, as you guys know, my crystal ball's not any better than anybody else's, but just for the edification of the new trustee, again, my name is Blake Mighton, I work for Sterling Capital. We manage about 2/3 of the pension plan here for the general employees. We manage specifically the U.S. equity piece, along with the fixed income portions of the plan. And then with the recommendations of your consultant, Mr. Cole and Burgess Chambers and Associates, you've augmented our core allocation, is what I'll call it, with other outside asset classes that we don't necessarily have in-house at Sterling or under the old Truist umbrella. So we've kind of got an asset allocation that's very, very diversified. But we manage about 60%, so I'll keep my comments to basically U.S. equities and fixed income, and let Larry talk about the bigger picture. But really, all of it was pretty good, Skip, as you'll see here in a minute. So with that, let's dive right in over to tab 2, starting on, I believe it's page 5. Yes, page 5 of the blue book material. And here is the market review or attribution, or what I affectionately call the scorecard. At the top of the table, we have all of the stock market indices, starting with the Russell indices, which are the U.S. benchmarks, and then we have the MSCI, or the international benchmarks as well. And then down at the bottom, we've got all of the Bloomberg fixed income targets. So to give you an idea, again, just a phenomenal period for the quarter, which is that second column. You see the Russell 3000, or that first row under equities, up a little more than 12%. For the year, that left the Russell 3000 just under 26%. So really solid returns there. Unfortunately, we don't have to go too far. If we go all the way back to the 3-year number, it drops down to about 8.5%, which is still very solid, but that obviously incorporates the very challenging year that was 2022 in that 3-year annualized number. But good solid numbers out of the U.S. market. A couple of things that worth noting is we saw a bit of what we would call a broadening out of the rally. For most of 2023, as you guys recall, it was really dominated by those magnificent 7, or those 7 U.S. large tech companies. The other 493, or in the case of the Russell 3000, the other 2,993 companies really didn't participate nearly as much as those big 7 did. But we did see a bit of a broadening of that during the quarter. But growth still did a little bit better. As we continue down, you'll see the Russell Top 200 growth up about 14% for the quarter. 200 value was only up 8%. Again, good solid numbers, but still led by growth a little bit. But we did see a bit of a broadening. So we saw small and mid cap also participate, and we can see that if we look at the Russell benchmarks, and whether it be the Russell 2000, the small cap benchmarks, or the mid cap indices. All up double digits, all very solid, very strong performance to finish the year. So again, we anticipate, as we look into our crystal ball, we think we will get some more broadening of the rally. We think it's going to be choppy. We think the ups and downs that we've seen just this week alone are probably pretty indicative of what we're going to see for 2024, because we're still right where we've been for the better part of the last year and a half, which is we're dependent on the Fed, we're dependent on interest rates. We're in this wacky environment that Larry alluded to, where bad news is received well and the market goes up, and good news, a strong jobs number and good economic numbers, are bad, because that means the Fed's going to keep rates unchanged for longer. So we're really in kind of a very unusual environment, but we're still playing it pretty close to our targets, and you'll see that when we look at the allocation versus our benchmarks. And not a whole lot of strong conviction one way or another. We still have exposure to large growth, large value, but we do think large value should start to do a little bit better. And as the economy continues to broaden out and the markets start to reward some of those areas that just candidly didn't go up as much in 2023 and look pretty cheap by comparison to some of those large cap tech companies that are looking pretty rich at this point. So lastly, down on the bottom, I don't want to forget about fixed income, because that's a big piece of the portfolio, and it was a phenomenal quarter. As you can see, the Bloomberg aggregate was up over 6.5% at 6.82. That erased the year-to-date deficit that we came into the quarter with. So we finished 2023 with about a 5.5% return, which was pretty much in line with what we thought when we started the year, thinking 4 to 6% was a pretty reasonable expectation, and we got it. We certainly didn't see it going down 2 or 3% for the first 9 months and then roaring back like it did, but we'll certainly take that as well. So really from that perspective, both U.S. stocks and fixed income had very, very strong periods, and you'll see that reflected in the numbers here in a minute. As we kind of look into our crystal ball, I alluded to what we think is going to be the most important variable, which is the Fed, but I didn't really get into what we think is going to transpire, and it's probably the rates are going to stay put for a while. We're not going to see that decrease, Patricia. I'm sorry. If you can push that refi to next year, that might not be the worst idea, because at least in our opinion right now, based on the current economic data that we have, it's probably looking like later in the year or early next year before the Fed lowers rates. Again, that could change, obviously, with economic data, but we're going to take Mr. Powell at his word. He said he wants to get inflation down to that 2% number, and as we all know, that last little mile is always the hardest, as the saying goes. Not that I've ever run a marathon, but
Investments, you don't want the rate to drop, but when you got to go out for debt, you don't want those high rates. So it's like, I don't know what I want.
yeah, it's tough. So if they do start cutting sooner than expected, candidly, that probably means some things are going awfully wrong in the economy, and we may not wish that on ourselves for just a couple of interest rate decreases. So from that perspective, there's kind of the silver lining, if you will. So with that, as you guys know, and for the edification of the new trustee, the rest of my first section goes into a lot more detail on the various asset classes and why we think what we think, and a lot of the economic variables that we factor into our thinking. I don't usually go into a lot of detail there unless there's any specific questions or comments on any of that. Usually dive right into the performance and talk about how our piece of the plan did. But before I do, let me just stop and open it up, see if there's any questions or comments on the bigger picture or the truest sale of sterling, any of the topics that we've discussed so far? Nope, okay. Let's review performance in a little more detail, starting on the next tab. Page 19. I wish we could get the font just 1 or 2 sizes larger. It wouldn't hurt. But first page is the portfolio overview. We've got the cash flows down at the bottom, and the pie chart there, you can see we're about 53, almost 54% in U.S. stocks, with the remainder in fixed income and cash. We started our fiscal year October 1st at a little over 18.16 million. Had net contributions of 345,000 when we factor in the city's annual contribution there. Had income of a couple $100,000, capital appreciation of a little over $1.5 million. So our piece of the portfolio stood at just over 20.2 million at the end of the year. So good, solid, absolute performance in dollar terms. And then over on the next page, we can put that into percentages. Got the bar chart at the top, but I'll talk about the portfolio trailing returns right there in the middle. The dark blue is us. For the month, we were up 4.87, a little ahead of our targeted benchmark there, which is a blend of that Russell 3000 and Bloomberg aggregate. For the quarter, we were slightly behind it, but still up 9.4 versus 9.5, 9.6. And then for the 1 year, up 15.3 versus 15.9. So good, solid absolute performance for the year. We were slightly below the benchmark, but I will gladly take a 9.4% return when the market's up 9.5. So. And then obviously, since we've transitioned over to sterling, you can see that factors in a lot of 2022, and that good, strong 2023 number goes down to about 2.5%, but still about 0.75% ahead of our target there. Looking at the various pieces of the puzzle, at least for the quarter, equities actually slightly outperformed. It was the bond piece of the portfolio that did a little bit worse, but again, 6.6% when the bond market's up 6.8 in the quarter. Again, we came into the quarter being a little conservative, and that's kind of reflected in that very slightly less than benchmark performance there for that time period. Really, the rest of my book goes into a lot more detail on the various aspects of the portfolio. I'll just touch on a couple because I know we're just 60% of the plan, and Larry's report will cover all of it. But over on page 21, we got some of what I call the geeky financial statistics. We can see how much risk we're taking to get that return up there at the top under the risk measurements. The two that we follow most closely are standard deviation and beta. Those are just measures of volatility, make sure we're not taking too much risk. And you can see both of those are slightly less than the index, which is meaning we take a little less risk than the benchmark. And then the other two that are most important in my mind are out towards the right-hand side, the up capture and down capture. That'll give us an idea of how we do when the market's up 1%. We expect to be up 0.99, and vice versa. If the market's down 1%, we only capture about 96% of the downside. So those are kind of the numbers we like to see. Don't want to put too much emphasis on those numbers because it's only been a year and a half or so since we transitioned. So those will be a lot more meaningful when we have a full market cycle to gauge us by. Over on page 22 is the allocation. Again, nothing earth-shattering here, real close to our targets. Our investment policy target is about 52% in stocks and 48% in bonds. And you can see we're about 53, 54. And that's really just more a function of stocks doing so good this quarter. We're probably a lot closer to our targets as we sit here today because we usually trim the first couple of weeks of every quarter to get back in line. And then the rest of this section goes into great detail on each and every asset class and how they did relative to their benchmarks. You know, again, the sum of it all is we were up about 9.4 when the market was up 9.5. So good solid performance from most of the funds. No issues or concerns with any of the products or asset categories in our opinion. And then I'm going to finish up on the very first page of the appendix. This is what I call Skip's favorite chart because he wants to know how we did over a long period of time, not just how we've done since Sterling got here. So what we tried to do was take the historical returns under Truist and SunTrust, link those to the Sterling returns over the last year and a half or so to give you a picture of how your plan has done over the last 3 years, 5 years, 10 years, and those longer terms. And as you can see, again, for the 3, 5, 7, and 10, all well above the benchmark. And then the inception is a little bit skewed because we've changed allocations so many times over the years. I'm not sure that number's all that relevant anymore. But so again, guys, in conclusion, really solid period. Great start to our fiscal year. Probably, knock wood, I was looking today, not including today's pretty strong markets, our piece of the portfolio is probably up another % or so. So that 9.5% fiscal year return for 3 months is probably closer to 10.5 as we sit here midway through February. So we certainly need to get all the way to September 30th, but we're certainly off to a very, very good start for fiscal 24. So with that, I'm going to shut up and stop talking because you guys look like you're about to fall asleep on me. But I get that too. I get that all the time.
Me?
No. I'm teasing. Any questions, comments, thoughts? Now when the numbers.
It looks great.
You know, you're into not into it yet, but I mean, had a few more days to wrap yourself around the ownership change, but is there still absolutely no indication of any personnel changes on the investment side?
Correct.
Every team stays the same?
Absolutely, 100%. No announced folks skipping, moving, anything, and we don't anticipate it.
Well, and it's the asset allocation group, because you guys do.
Investment advisory group in Raleigh is all completely 100% intact.
Okay.
We actually had a call yesterday morning,
Okay.
and it was business as usual. We just talked about, the February updates based on the January 30th numbers. We get together every month and kind of set our asset allocation. There's a team in Raleigh that helps us with all the variables. And overweighting and underweighting various aspects of the asset classes. Really no change. This month was kind of status quo. Well, as always, guys, thank you very much.
Thank you, Bill. All right. Next is Mr. Larry Cole from Burgess Chambers with the quarterly report.
All righty, thanks. Well, hello again, good afternoon. Again, for the newer trustees, our role is, it's the white book. Doesn't look quite like this, looks like that.
This one should.
This is Burgess Chambers and Associates. You'll hear me referred to as BCA also. We're the investment consultant. We don't actually manage the money, but we make recommendations to you on how this money should be managed and what managers should do it. So Sterling has, as Blake mentioned, has about 60% of the assets. At one time, years ago, I think they had 100% when it was SunTrust, SunBank Capital Management. So it's kind of evolved over the years. They've sold investment arms and bought one, sold them out. And I think we kid Blake, he's worked for the same group now for 20 years or something, and he's had 16 business cards or something, because they change names so often, but, you know, he's still working for the same group. So as time evolved, a lot of the asset classes, we wanted to diversify the portfolio more into different asset classes, and they didn't have them under their umbrella at Sunbank or all the firms that he's worked with in the past. So recently, last few years ago, they kind of opened up. They've got a whole different group in, I guess, in Raleigh that does, they will actually go outside of the Sterling umbrella to pick funds for some of the portion of the portfolio. So we allowed, at that time, the board allowed them to keep the money, keep managing that portion of the assets, 60% of the assets. And so you'll notice there's lots of different names in there, but they're all kind of managed under the Sterling umbrella. But outside of that, the international piece, the convertibles, the real estate, what we call infrastructure, which is their domestic stocks, but they're focused on government infrastructure spending. I guess those are the four areas that aren't under their umbrella. We monitor the entire portfolio. If they start struggling, we don't like their numbers, something goes on at the firm. That's why I asked the question I asked. We'll keep a close eye on that on your behalf, that if there's turnover at the firm as a result of this ownership change, you know, ownership change raises flags all the time. This one, I think, is a positive. It actually takes the Sterling Group out from under a bank's umbrella, and they become they're an investment firm, and Guardian owns a couple other firms that, one of them I'm familiar with, and they have left those people alone. In other words, they let them run their shop. Where they can benefit sometimes, where the investment management firm benefits, is through in the back room. They may be able to consolidate some things in the operating side, administrative side, or even the compliance side that could benefit the firm as a whole, but usually leave the investment management teams intact, and so you don't have any change in the way they manage the money. So we'll keep an eye on that for you too, and we would be the ones to make recommendations if we want to change managers. If we've got a manager in the lineup that just isn't doing very well, we'll make that recommendation.
Question.
Yeah, Bill?
So I've always been a little confused. He manages 60%. Who handles the money for the other 40%?
I make recommendations to the board. In reality, the board manages, the board has the say on everybody,
Yes, I
including Blake. So I kind of look at Blake and his firm as one manager out of maybe, what do we got, 6 or so in this portfolio. Now his one within that umbrella has 12 or something different funds that they put it in, but we're holding them accountable for that portion of the money. We hold each of the individual funds and managers accountable for that other 40%. So I'm monitoring that constantly, and I make recommendations for when we change.
So they are investing and handling the other 40%.
They don't manage like if you go, that's good, I'll just skip around a little bit.
I'm sorry.
No, that's a good question. If you go to page 12 of my report.
And it's not a concern.
No,
I've never
it's
been
just,
able to understand.
it is confusing, and it is a different setup than we have. I think I have this set up maybe in only 2 other plans that I work with. So usually we have 13 or 14 managers in a pension fund. This one, because of its history and how it kind of evolved, where Sunbank was managing 100% of the assets, then they stayed involved the whole time, no matter what their new name was, and stayed involved. And as we diversified more, they were doing a good job. So then they developed their own in-house capabilities to evaluate outside funds. So when you go through this, you'll only see 2 products in here with Sterling's name attached to it, with Sterling's name attached to it, even though he's Sterling. That's the Sterling Equity Income Fund and the Sterling Fixed Income Fund. Well, Sterling actually manages those funds. They are literally in there buying the stocks and the bonds for those funds, right? The other funds, Loomis Sales, Vanguard, Federated, Hotchkiss & Wiley, Touchstone, and the Russell Midcap iShares, those are all managed by Sterling, but a different group that looks at funds outside. They're not actually picking the stocks for the Loomis Sales. Loomis Sales picks those stocks. And they're just evaluating the funds and deciding whether they want to put that fund in their lineup. So, and then the ones that aren't under their umbrella would be, and you don't have any way of knowing this, by this report, but it would be the convertible bond fund, the iShares convertible bond, Cohen and Steers, the Lazard Global Infrastructure, the American Funds Euro Pacific, and then the two real estate products, the Schwab REIT and the Predex Fund. Those are two real estate products. Those are all products I've recommended to you over time to diversify the portfolio more. And, you know, if they had at the time access to those, maybe we would just let them do it, but we do this all the time. We have our lineup that we like, you know, that we recommend. We're constantly, we being BCA, we interview probably 100 managers a year when we're not out doing this. We're doing a lot of due diligence on investment management firms. We talk to a lot of them that quite frankly, a lot of them we'll never talk to again, but, you know, we learn something usually in a hour discussion. And it might be that we never want to talk to them again, but at least we learned something, right? So we're doing the due diligence constantly on these asset classes too. We're familiar with some of these funds that they put in there too, actually, all of them, to be honest with you. We've used them in certain places also. So it's a little bit of an overlap here. It's a little different, like I said, than most plans we work with, but as long as Blake and his group continue to do a good job, we won't rattle the cage.
I think what Bill's asking is, does somebody from Burgess Chambers decide what that lineup is going to be?
Not the one that's under their umbrella.
No, the other 40.
The other, yes, that's us.
That's what he was
I'm
asking.
sorry, long answer to a very short.
No, that was very helpful.
It's okay.
Yeah, we're the ones making the recommendations on your total lineup, actually.
And the managers he's talking about are the ones that work for that fund.
Yeah.
Thank you.
Much better explanation than mine, yeah. So back to the report. So our report is covering the total portfolio. So this is how the overall pension fund does. On page 2, on the top of that page, that's just the various market indices, and that's telling us how stocks did, various bond funds, or bond indices. So how the stock and bond market do, basically. And you can see everything was up for the quarter. The S&P 500 index, that's large cap stocks, large companies. The Russell 2000, that's small cap companies, smaller companies. The EFI index, that's international. Emerging markets, that's the developing market kind of countries, or emerging markets, as it says. They're smaller countries. And then you get into some bond rates. So anyway, that's just that's not plan specific. That's just an overall look at the market for last quarter. Well, it was hard not to make money last quarter. Everywhere made money. Bond funds were even up. Now remember, bonds, if you're already holding a bond and interest rates go down, the value of the bond goes up. So that's how you can see some pretty nice returns in bonds when rates go down, which they did a little bit last quarter. This is the exact flip of last quarter's chart, by the way. If you looked at last quarter's, this chart was just the opposite. Everything was down except for commodities, and they were up. So what happened in the quarter, right in the mid-quarter, just to remind you, if you did follow it, that the CPI, the inflation numbers came out lower than expected, like 3.1, 3.2%. It got the market all excited that the Federal Reserve now would stop raising interest rates and would indeed start lowering interest rates because inflation was under control. I said at the last meeting here, I thought that was a little premature because the reason the inflation number came down, the CPI came down, was energy's included in that, and gas prices came down quite a bit in the fourth quarter. That didn't make any sense to me either because there was a war broke out in the Mideast with a good chance it was going to expand, and that's not an environment that usually you see oil prices come down. They go up, but they didn't. They went down. So I thought that was temporary anyway, that the core inflation, which takes out food and energy, was still at 4% back then. So that was nowhere near the Fed's target of 2%. So I thought it might be temporary. It turned out it was. The numbers that came in just this week kind of spooked the market because it said, hey, inflation isn't done. They're not done yet with inflation. And the hope that they would start lowering rates aggressively in 2024 went away. So that's not going to happen until probably later in the year. And so the markets don't like that. They want rates to come down. So that's what's kind of spooked the equity markets here lately. The next page is the bond market. On the top, that shows everything was up, and then the international on the bottom of that page, everything was up. So it's a good quarter. We do a policy review compliance page. This is all, again, for the new trustees. You have an investment policy statement. All of this is in that investment policy statement. What we do is just kind of provide you a summary every quarter. If there's any compliance issues, we'll tell you. and we'll try, we'll have to fix them if it's compliance related. If it's just performance related, that doesn't necessarily mean you fire that fund immediately. We're evaluating those. We understand why sometimes they underperform short periods of time, and may say just stay patient. So that's what that page is all about. Now, on page 6 is a summary of performance. This is net of investment management fees. So this is after fees. So you can see for the quarter, we started off with a market value of $29.2 million. The net contribute, these are net contributions. So this is money that came into the pension fund, less money that went out of the pension fund for benefits, fees, or whatever. So it was positive cash flow this quarter of $312,398. I believe that reflects the city's contribution that came in for the year. So we had a positive quarter. We usually don't have a positive year. There's more money going out than coming in, usually, unless we have great earnings. Well, and we do have enough earnings to offset it. As you can see then, the gain for the quarter was $2.6 million. It was a great quarter. And then the ending market value was up to $32.2 million. The total fund returned 9.1% net of fees for the quarter. And obviously, that's a great quarter. Yes, Skip?
For the edification of the newer members.
Yes.
Back on page 5, up in the green in the top there, like the second line or the fourth line, you see that the actuarial assumption rate's 7.25%. That means year over year, trying to average 7.25 to keep the plan healthy. When I came on 16 years ago, it was 8%. And we were sketchy hitting 8%. And I just continued to ask to bring that down so that we have a better opportunity to meet that goal and not get in a position where we can't pay our retirees and now we got to raise, property taxes and revenue sources against the residents of Cocoa Beach just to pay the defined benefit pension plan. So by bringing that number down, it actually costs the city some money on a yearly basis, but we won't end up in a big pinch in the downstream.
Yes. Less of a chance you'll have a big surprise. Yeah, that's a good point. The actuary is actually here today, and he'll be giving his report. But an actuary makes a lot of assumptions. Payroll increase, all this. They make all the calculations to decide how much the city needs to put in to keep this plan healthy, or funded, I guess is a better word. And one of the biggest assumptions in there, their biggest impact assumptions, is the earnings assumption rate. So, we are assuming this plan over the long term is going to make 7.25%, and we recommend the asset allocation to you based on that assumption rate. This is what we think is the best asset allocation, and then within that, we'll suggest the managers to fill the slots of the asset allocation. So this much in stocks, this much in bonds, this much in real estate, this much in alternatives, whatever, and then we'll recommend the managers to fill those slots to you. So that's our driving factor. If that was 8%, we'd have to get much more aggressive. You'd have less in bonds. Right now, we have about 30% in bonds, and so it's back in the day, 20 years ago, maybe you could have 60% in stocks and 40% in bonds and expect to make 8%. That hadn't happened since interest rates went down to 0. So you had to get a little bit more aggressive and a little bit more in stocks or other convertibles and some other asset classes. So again, on page 6, if you go across the page, then you can see the 5 years. You can see how much the net payouts were, about $4.5 million, but the plan did earn over $12 million. So even on a 5-year basis, this plan net of investment management fees has earned 8.8%. The assumption rate is 7.25%. That's a good thing. That's a nice spread. So that should actually lower. If you do better than the assumption rate, if no other variables are off, that should help the city's funding costs come down a little bit. Your asset allocation is on page 7. That's a very complicated, we got too much detail really on there. I'll just summarize this for you. There's about 40% in stocks, domestic stocks, about 10% in convertible bonds, which are bonds that are convertible into common stock. They're a little less volatile than stocks. 13.7% in international stocks. We got a little over 4% in real estate, which is combined of a direct real estate commercial investment and a fund a direct fund investment in commercial real estate, and also what we call REITs, which are really stocks that are related to real estate. And then about a little over 30% in stocks, in bonds and cash, or bonds and money market fund. So I'm not recommending any, this would be, there are times when I come in and recommend rebalancing, that if we get a little out of whack with the long-term target. I'm not recommending any rebalancing here. It does look like we have a lot more in mid-cap, but when you add the two together, small and mid-cap, that's a 10% target. We're at about 14. But right now, the valuations in small and mid-cap stocks are extremely attractive relative to their historical valuations relative to large cap companies. So small and mid-cap companies are very, very cheap right now.
Why is their target allocation in large cap core equity 0?
We don't really have a core. We have it broken out between value and growth. See the 12.5 and 12.5? This is, I need to change this chart actually, because we didn't break it down that much in the investment policy. This is just trying to give you more information. But
Those darn computer programs.
this chart, I just need to refresh it because it's not, we don't need to get that detailed. You really just want to know, what have I got in stocks? What have I got in bonds? What have I got in real estate? And then another breakdown right below that, no reason to go there. Page 9, just you can kind of look back at the history of how the allocation's gone. We haven't made any major changes, but we've shifted a few things around here and there. The market does a lot of it too. Now, the next page, page 10, this gets into your actual returns. These are gross of fees. But you can see the total fund did 9.2% for the quarter, had a wonderful calendar year, 14.6%. That strategic model is kind of the benchmark. Again, that's all spelled out in the investment policy statement. The 3-year number then includes 2022, which was one of the worst years I've been doing this for 40 years, and it was the worst year I've been involved in. Not only were stocks hammered in 2022, but bonds were down 14% because of the rise in rate. When the Fed raised rates 11 times in 18 months, market value of bonds goes down. So the actual bond returns were record lows. Never had a minus 14% year. So that was a bad year. That's included in that 3-year. That's why that number's so low. 4-year, 6.4. But even with the worst year I can remember, the 5-year number is still 9.3% per year gross of fees. So it's done pretty well. And then this is just a breakdown of all this, of the different asset classes that you are in and how each of those have done relative to their specific benchmarks, and that's one of the tools we use to evaluate how Sterling's doing and how the other managers are all doing. All your funds are broken out on the next page, on page 12, which I already referred you to, and you can see how they've all done on an absolute basis. Again, a great year and a great quarter.
Where's the combined risk chart?
Well, let's go to, I'll get there. Go to page 14 first. This one you usually like to look at too, Skip. The blue line is the market value of the assets dating back to December of 2018 in this chart. The green line is the net cash flow. So you see the green line's kind of tapering down, meaning more money's going out than coming in. The blue line is the market value each quarter. So these are quarterly plot points. So this shows market volatility, right? So at one time, we were actually up over 36 million in 2021 in the plan, and then you see what happened to 2022. We lost a lot of money in about 18-month period there. The plan got hit. There was just nowhere to hide. Everything went down. But then it's coming back pretty nice. And as you can see, we're up to 32, a little over 32 million, almost 33 million, and we're probably over 33 million as we sit here today. It's gone up just a little bit more. So heading back up north after a disastrous 2022. Page 15, is this the chart you're referring to, Skip?
Oh, yeah.
Risk reward.
I was flipping through there, and that's the one I was looking, I saw the individual ones, I missed that one.
So I usually don't spend a lot of time on this.
Yeah, but for the new.
Yeah, for the new trustees. What this does is tell us, it's a risk-reward chart. So the 5-year risk-reward. The triangle is the benchmark. Again, that's that's spelled out in your investment policy. This is what we're trying to match or beat. And the blue circle is actually your portfolio. So your total fund has done slightly better than the model. If you look over to the right there on the top, your return has been 9.26. The target, if we, by itself, was 8.87, so a little bit better. We'd have been happy just to match it, but that's good, we beat it. And then the standard deviation is a measurement of the risk. Now, we did have a little bit more volatility than the benchmark, but we got rewarded a little bit for it with a little bit higher return. We'd rather be, the ideal spot, everybody's goal is to be in that top left quadrant. That would mean less volatility and higher return. Hard to get there, but that's what we shoot for. So we'd like to see that blue dot move over there, but if it's going to be to the right, we'd like to see a little bit more return. We did get a little bit more return. Now the 3-year doesn't look as good. We got a little less return and a little less. And again, that's 2022. It just blew a lot of statistics out of the water. So I'm not too worried about that. That's a short-term aberration, I think, and we're moving back in the right direction. You saw the 1-year return was excellent. Another nice chart you might like is page 16. That's going back to 2005, looking at your fiscal year returns. Your fiscal year ends on September 30. So it's not a calendar year, it's a fiscal year. And these are your fiscal year returns. Again, you have a 7.25% assumption rate that the actuary is using. They think you're going to earn on average 7.2. You've pretty much done that. Doug will probably have longer term numbers, but I think you're above that on the long term periods. Even our 5-year number is above that, despite a minus 18% year in 2022. So you can see everything's fairly, well, we did back in the financial crisis of 2008, 2009, that was a rough period. Then things are pretty smooth, and then you get to 21 and 22, and again, I've been doing this 40 years, never seen that kind of volatility. We go up from a 21.6% positive return to a minus 18% negative return. And, that didn't end Investments 101 when I was in college, so you just got to wave your way. You got to kind of put the noise aside and still focus on the long term in periods like that. And you've come back well. You had a great fiscal year last year of 11, up 9 already for the quarter. We're probably up 10 as we sit here today, a little over. Whether we hold on to that through September, who knows? Who knows? But that just shows you the kind of volatility we've been in. And then there's a lot of charts at the end here that I don't usually cover with you. We use a lot of this information to determine if changes need to be made. You can see there's just a lot of data here on risk and reward, upside market capture, like when the market goes up, how does this fund do, or how does this category do in your portfolio versus the market? If it goes down, does it protect well in down markets? We look at all that stuff when we're trying to evaluate whether we need to switch managers or make changes. So there's one of those charts for every asset class you're in. And I think with that, I'm done. So you'll have this book every quarter from us, which again is the whole plan. As a new trustee, if you have any questions and want to give me a call, Tricia has my number. Please feel free to call me. You can't have another trustee in the room under the sunshine laws if you make a call. It's just one-on-one, we can talk about anything. But if you have any other trustees in there, we're kind of limited to what we can discuss. So with that, Skip.
Did you bet any money on the Super Bowl?
I actually did. Not your money, though.
You did?
I did. 5 minutes before, I was with my daughters and their son-in-laws, and both son-in-laws, right about 10 minutes before the Super Bowl, they told me, I said, well, I'd like to make a bet, but DraftKings won't let you bet in Florida. And they said, oh, you can go to Hard Rock bet Hard Rock or something. There's an app, Hard Rock. So right before the Super Bowl, I'm opening this app up, and I put some money on the Chiefs, and I won.
What about you, Blake?
It paid even, because my kid had me do the same thing. I put 50 on the Chiefs, and it was straight up.
That's exactly what I did. I put 50 on the Chiefs.
The money line was even, so.
Okay.
Well, I put 50 on the Chiefs. I put them with the spread and without the spread. And then,
Spread on Hard Rock now?
yeah.
But let me get to my point. So Doug, did you bet on the Super Bowl?
I'm from Michigan, so no. My Lions almost made it.
Okay. All right.
Why do you ask?
So, okay,
Why do we ask?
I ask because on the day, well, the night of and the day after the election, where do you think the market, where would you bet the market will go if Biden wins, and where would you bet the market will go if Trump wins? Because that's going to be, it'll be after our fiscal year, which is the good thing.
Betting is an appropriate term there, because it really is a crapshoot. There's no statistical evidence, and we've had this conversation, I know I've had it with you, but for the edification of everybody else, there's no statistical significance on a Democrat in power winning, Republican winning, any of that. The only statistical evidence that shows any kind of correlation to market performance is if all three houses align under one party. And it doesn't matter whether it's Republican or Democrat, if you have the House, Congress, and the President all being one party, and the logic goes that they'll have an easier time getting their agenda pushed through, so it's a little more predictable outcome, because you can tell, all right, Republicans are pro-energy, maybe I'll buy some energy stocks, right? It should be a good environment for that, if the Republicans carry all three houses. But honestly, there's nothing that says the Democrat does this, the market does this, or vice versa with the Republicans.
Okay, I was asking, I didn't ask about
Yeah,
the
so it's-
statistical evidence. I'm saying if you were going to bet in which way the market would go on either
It's
one.
just that, it's sort of, throwing a dart at the board. But I bet the most participants would be looking for a change in the Oval Office.
Okay.
That's where my $25 would come.
Thank you, Larry. Next is the actuarial valuation report presented by Mr. Doug Lozen from Foster & Foster.
You don't know mine, I'll come a little closer and
Yeah?
have a seat here. My report is on the iPads, and I know they went blank. So if you quickly tap the button at the bottom and then hit it again once the screen comes on, you'll see a touchpad. And the password is 436022. Tricia has paper.
I also kept mine.
So good. Everybody else good? Nice to see everybody, and I made my introductions to two new trustees here. I'm the actuary, I'm with Foster & Foster. So among other things that we do for the trust fund, we work for the pension board, by the way. We do work on behalf of the trust fund, but we're hired by the pension board. We do this big report every year. It's called the valuation, the pension valuation, but we also do the benefit calculations for the members. If the city is in negotiations and they want to see, say some benefit improvements or benefit changes for the pension plan, we run those numbers. And we do also the governmental accounting schedules, GASB, and that goes to Patricia and sends it along to the auditor. Yeah, question, Skip, or?
No.
Okay. So I just wanted to get you an idea of what my job is as the actuary. The big picture of what an actuary does is we put dollar values on risk. So the actuaries work not just for pension plans, but they're out there doing other things in the world, like when you get your insurance premiums. And that'd be any type of insurance, auto insurance, hazard insurance for the house, flood insurance, life insurance. It's actuaries who look out into the future, many years out, and try to anticipate what events might happen and put dollar values on them. And then figure out, okay, well, if the person who wants to buy the insurance wants to pay a premium, what are we going to tell them? How much is the premium? That's what an actuary does, is we calculate those kinds of numbers. It's really a combination of finance theory and probability. So for a pension plan, our job is to give you a report every year that once approved, the city has an adjusted contribution requirement for the pension plan. We will change the requirement every year a little bit, ideally a little bit, either up or down, to tweak the contribution requirement so that as members terminate throughout any point in their career and are either due a benefit or due a refund of their own contributions, we're telling the city exactly how much should go into the pension plan to be invested with Larry's input, with Larry's advice, and how it should be invested, so that when the bill comes due for those benefits, the money's there in the trust fund. That's our job, is to keep it actuarially sound. So this is the big report we do every year. And because we have a couple of new trustees, I'll go into a little bit more detail than I do in a normal year, just to get kind of like actuarial 101, to show you in kind of a big picture of how we do this.
So,
Yeah, go ahead, Skip.
so we can, like, he could say we need to go from 7.25 to 7.5, based on what he's thinking, okay? And that's what we would normally do. If he says go down, we go down. But we can say we want to lower it to 7. That's when the hair on Patricia's neck stands up, because then all of a sudden, to keep from talking to Doug and the actuarial, they're saying, well, if you're going to go to 7, then the city needs to put in this much more money every year to still meet your targets. Okay? What he's going to tell us is where we're at now, based on how he feels that the city should be contributing out of the funds that come into the city to keep the program whole. Is that a good analogy?
So each employee pays 5% of their income into the pension program. And so Doug is going to look at how much of those contributions go in, how much is the program earning in interest, and how much is it going to need to spend between now and 100 years from now? And what's the delta? And that's where he comes up with, that delta is what we have to contribute as a city to make that, kind of make that gap, to get the fund 100% funded. And there's other factors that go into it. And correct me if I'm wrong, Doug, right now we're not 100% funded. It's because it's looking at all of that loss that we took on interest earnings in fiscal year 22, because there's a 5-year rolling smooth.
Yes.
So we've got another couple years before that huge loss from 22 falls off. So we still look like we're in a bad position, but in another 3 years that will change again.
So very good comments. Thank you, Tricia, I appreciate that. Let me get into, when I had you fire up the iPads, there's a normal page I start on. I'm going to start on a different page. You can get to different pages of the PDF by swiping right, and go to, it shows page 9 at the lower right. And at the top, it shows comparative summary of principal valuation results. So this starts real high level, and then I'll get down into a few more details. And I promise I'm going to try and make this short and not overwhelm you with details, because learning this stuff it's a big curve. Actuaries, we have to study this stuff when we're young and able to devote all of our time in the world to it without families and so on. It takes about 5 to 10 years of going through exams to understand this stuff. So look at the very bottom under the word total on this page. And in the left-hand column, you see that $40,962,000. That is the actuary's opinion of how much you would need to invest today as a lump sum. We'll round it off, call it $41 million. Assuming that wherever you invest it, you can get a perfectly 7.25% investment return in the future. If you could do that, in theory, every future check that would ever be cashed from the pension plan would be covered. So initially, when you put in that $41 million in the first year, while you're expecting to get that 7.25% return, some people are going to come knocking and say, give me my pension benefit. Those people are going to be the retirees, first of all. And if you look under item A towards the top, annual rate of payments, you can see those are benefit payments in payment status, service retirees, beneficiaries, and disability. And that's about, we'll call it $2 million a year roughly. So right away, out of that 41 million that you would invest, 2 million's coming out every year. But then we're turning right back around and we're getting 7.25% interest on that 41 million. And so it grows. So in that case, what's happening is is what you invested is actually growing faster than the benefit payments going out. But over time, new people will be retiring and coming to get paid their check, and other people will be leaving and taking a refund. And the whole time, those assets are growing, but you have more and more people coming in and drawing down on it until eventually the last person to ever cash the check, in theory, would be the exact amount left of that $41 million that's grown all of those years at 7.25% interest. Yes, sir.
So, pardon the ignorance. You say invest 40 million today.
Yep.
We're investing about 30 right now.
Yes.
The total plan value.
Yep.
32.
That's what you have.
Right,
Yep.
just taking away cash or whatever, but.
Yep.
Okay, just to wrap my head around it. Okay, I got it.
So that's why you have a contribution requirement. That's a perfect segue. We need 41 million to pay every future check, but if you look under item B, I know you see two different asset values there. One says 28.9 million and the other shows 31.5. For the purpose I'm covering here, we use the actuarial value. That's a 4-year average. That's a 4-year smoothing. We're using that 31.5. So that tells me, just do simple math, we need about $9 million, a $9 million deficiency there, right? Well, that's perfectly fine, because that 41 million, I said, is for every future check. There's still people who were hired by the city in the last couple of years have a long ways to retirement. So we don't need all $41 million today. So that's why I tell the city they need to put in something every year to be invested, because we have $31 million in. Eventually, we're going to need that 41 million plus. So we need these extra contributions every year to be invested at 7.25 to pay for those future checks that are coming due. You don't want to be 100% at any given time. That's like telling newlyweds, in their 20s, you need to pay the house all at once. You're 25, you need to be 100% invested in your house. Like, well, that's great, but you don't need to. That you usually take out a 15 to a 30-year loan, right? That's how we fund the pension plan, is we fund it, really it's a little more conservative than that. It's about 15 years on average, between 12 and 15 years that we try to fund this deficiency. So, with that, let me have you swipe over to page 12, and let me show you the fact that, okay, we need 41 million to pay for every future check, and we've got 30-some million in the bank. Mr. Actuary, what do you tell the city they actually need to come up with every year to fund that deficiency over that 12 to 15 years? And this is the breakdown page. So if you look in the left-hand column under, at the top, pension cost, the first number you see is normal cost, 11.09%. That's a percent of payroll, by the way. That is the amount that actuarially we've calculated based on the average age and the average past service and the average salary for every member in the plan. We actually look at every single active employee in the plan and look at their age, past service, and salary, and the benefits the city has agreed by ordinance to pay for pension. And we calculate you need 11.09% of payroll going into the pension plan total to be invested at 7.25, and that will cover future retirees going into payment status.
That's a good point to tell them. 7.25 plus the 5% contribution brings you up closer to that 11.
Well, it's 11 all in. There is a reimbursement under there, a small number, administrative expense, 0.67% of payroll. That's a reimbursement every year. They're paying the actuary, you're paying the attorney, paying the investment consultant. Added up, it's 0.67% of payroll. But just think of it purely as what is the cost?
What was it?
Sure.
You kind of missed what I said. If you look at your expected member contribution, then you look at the expected city contribution, that's bigger than your projected annual 11.9%.
It is, and
And that's a good thing.
yeah, I'm going to get to that exact point shortly of where it comes in. In a perfect world, let's say you had no debt, no past service, you have no unfunded liability, and you have no administrative expense, what do you need to put in every year to fund for people that are marching through their career towards retirement and they're going to get a pension? We need that 11% of payroll to go in every year. The members put in 5%. So in theory, that would leave the city at 6% of payroll. In a perfect world, you have no past debt, and you have no administrative expense. Members put in 5%, city puts in 6%. So the question is, well, Doug, you're showing expected city 11.59% of payroll. That is mostly due to the unfunded liability payment. Think of that as your debt, your mortgage payment for the house. So if you go up just a couple of rows, you see that 4.83. Part of the city's contribution requirement is 4.83% of payroll for the unfunded liability payment. Those are things that have happened in the past, either with benefit changes or you fell short on your assumptions. Let's say in years when you didn't get your 7.25. Like Patricia said a few minutes ago, in fiscal '22, every plan fell short of the 7.25 by a lot. It was a negative return. We're phasing that in over 4 years. Also, the last 2 years, the city did something that I've seen every city without exception do in Florida. They gave big salary increases. We expect pay increases of about 5% a year. And the last 2 years here, it's been double digits. There's a bidding war going on in Florida. Municipalities are trying to get workers for general employees, police, and fire. And with inflation and with the cost of housing going up, think about the rule of thumb. What percentage of your income should be a mortgage payment? It's 25 to 30%, right? Well, in most places in Florida, it's going to be hard to find a house for less than $300,000 or $400,000. So what does that mean? You need to make about $100,000. And governmental salaries were not at $100,000 a few years ago. They're getting there. If it didn't happen, then governments would not be able to hire people. They'd be going and doing something else. So that's why I see bigger than expected salary increases the last 2 years here, as I've seen everywhere else. That has a part to do with why the unfunded liability payment's almost 5% of payroll, is these are things we didn't expect to happen. We didn't expect a negative return on investments in fiscal '22, and we didn't expect double-digit salary increases the last 2 years. That's why the city's requirement's gone up a bit. That's why the city's requirement is not in that perfect world of 6% of payroll. It's that 11 plus right now. We have to pay down things that have happened in the past that we didn't expect. So where we go from here, part of what I do as the actuary is that, okay, I'm asking you to approve this today, this report. And when you do, Patricia has a new contribution requirement. If you look in this page, you would be approving 11.59% of payroll for fiscal '24-25, and last year was 9.19. That's the true up. That's why you have to go through and see the actuary every year. I need to give you this true up number. And I will tell you that if we could roll forward, get in a time machine and come back 1 year from now, when that 11.59 goes to the right-hand column, and I'm going to give you a new number, it's probably going to be higher. Because fiscal '22 investment loss is still phasing in. Now, we do have investment gains. We had an investment gain in '23, and we had a nice investment gain in '21. But '22 was a bad year. When you factor them all in, it's going to be below your 7.25. Your 4-year average is going to be below for a few more years. Eventually, we'll get through it. But before then, and this will be for Patricia, my guess is that 11.59 11.59 is probably going to get in the 14% of payroll range. That's my best guess today.
Next year.
Now, here's where I'll caveat it a bit. That's given the way payroll is today. To the extent that the city is growing and hiring new people coming in, the cost of a new employee is 6% of payroll because they don't come in with any past service. I showed you that 4.83% of payroll for the unfunded liability. The more that you can grow, the more that you can hire people to come into the city, you're going to help the pension plan. Their 5% contribution is going to help pay down the unfunded liability faster. This is where you've heard in general, like with discussions on the economy, with Social Security, growth is good. You've heard Elon Musk he said, I'm doing my part to help the country. I have, 9 or 11 kids, I think. He says, growth. You need more people. You need more people at the bottom in society or in a pension plan to be there to take the place of those who leave at the top and draw down and draw pension. Growth will be good because a new hire to the city is 6% of payroll. Patricia will be funding the 11.59 in this next year, there's no doubt. And when new people come in, she's going to be applying that 11.59. But I'm telling you, actuarially, that person's only a 6%. And so what will happen is I will come back the next year and show that the city's contribution is beginning to stabilize because of that growth. So I don't know if you're planning on hiring new people. My guess is maybe, but,
We don't,
Mostly attrition.
okay.
Yeah,
Well, I
we-
just wanted to bring it
we
up.
don't
just-
really have any current discussion for adding any FTEs. I don't see that happening
It's
going.
pretty stable here. It's
Yeah.
135, 134.
Matter of fact, we've actually been doing a little bit of reduction
Okay.
in staffing. I mean, like Rockledge, they were so behind in salaries. This year, the average was between 4 and 4.5% increase in wages. And Rockledge did 9. They're so behind us. They're having a hard time hiring.
They are. You
hiring.
guys did 13.5 in '22 and 14.8 in '23. I mean, that's my calculation. I know you have a slightly
Well,
different number in mind, but
It's because you're looking in the aggregate, but
Yeah.
just in terms of citywide, all employees affected, it was 4.5. But you're looking at how much the total wages have increased.
well, did you do steps as well? Say everybody gets a COLA plus a step?
No, she did a 2.5, well, what was it last year for 23?
4.5, I think, last year. I thought it was.
But it was, she still stepped it, so there was one at like 2 or 2.5, and then the other was, she did the same thing for fiscal year '24. She did a 2.5% in January, 2% in, I think it's May. So it's 4.5% total for the year, but that's not how you look at it. It's just the increase percentage-wise between total wages paid and
Yeah.
total wages paid. So it's not a citywide, what is everybody getting across the board? It takes into account everything.
Yep. Okay, so I think I'm hitting my limit for keeping you focused because I understand I've done this for many years, and then before that, I had to take a lot of math in college, so I'm not going to get you down in the weeds where I'm at any more than I have. I hopefully gave you some insight into what I do every year. And when you approve this report, kind of a general sense of what you're approving and that it makes sense. And why you need to see me every year because I have to refine this. We are projecting everything into the future until every last check is cashed, as I mentioned, using assumptions. I'm using the 7.25 for investment. We're not going to change that every year. We're not going to say, oh, last year you did well, so we're going to increase it, and the next year you did worse, so we're going to decrease it. We lock it in. We lock in salary increase. We assume 5, because long-term, that's about right. We understand there's going to be times when the city needs to give more. We have life expectancy assumption, mortality. All of these assumptions are built in. So we come back every year and measure what happened compared to all of those assumptions, and then we do this fine tuning. Every 5 years, I'll come back and say that we need to do a bigger study on the on all the assumptions. The last time we did that was in '21. So we don't need to do that again for another 2 years or so.
So are you saying that, you're saying next year it's probably gonna be 14?
It's getting there. I don't think it'll be there next year. In the 2 to 3 years, I think it'll be
But are
there.
you saying that if the employee puts in 5, the city needs to put in 9?
No, I mean 14 from the members will always stay at 5. I'm meaning the city will go from 11 point plus right now to roughly 14.
Right, but that 5% is off of the 14, you take off of the 14, right?
No,
So they put in 14, you're
Right.
saying? Okay.
yes.
But in 3 years from now, we should see that number starting to decrease
3 years.
in 3 years.
The biggest, I'm going to call it a spike here, because we're using a 4-year average. Is it 5?
I think it's
It-
5.
it is.
I said 5.
Yeah, let me double, most I use are 4, some are 5, let me just double check.
Patricia said 5 earlier, that's what
I think I think we're 5.
It's 4 here,
4.
yeah.
Well, then, we should, 2 years from now, we should see starting to go down, because we've already got 2 years of good returns.
Actually, in 2 years, you're going to see a spike, and then in 3 years, you'll see it go back down. And let me tell you why. Fiscal '21 was a really good year. You got 21% investment return. And 1 year later, you got a negative 19. That's a 40% swing in 1 year's time. A positive 21 compared to a negative 19. The smoothing works great, but there's a downside to it too. The reason the smoothing works great is because we spread out over time gains and losses to try and keep the city's funding volatility even. Where the downside comes in is in 2 years, we will no longer be using any part of the fiscal '21 gain. That 21% falls off, it's fully recognized. But you have 1 more year of the negative 19. That's going to be a big year. That year alone could be 3% of payroll. So when I say you're going towards 14, it might mostly happen in 1 year, which is 2 years from now.
That's going to be the worst year, 2027.
Yes. It'll be the
Assuming we don't have a good
20,
year to replace it.
it'll be the 25 valuation, so it'll be the 26, 27 funding year is when you should expect a spike.
Could we have a look at one more page, page 20?
Sure.
Page 29.
29. There we go. Okay, 4 years, yep. Investment return.
So it's saying an annualized rate of return for 4 years is only 4.72%
Yes.
because of that big 19% drop last year.
Yep.
But what he's saying, let's say we add 2024, we get our 7.25. 2025, we get our 7.25. Sooner or later, that 20 plus, which is like 3 times 7.25,
Right.
it's going to drop off.
Right.
And you're still going to have to live with the almost
The-
3 times 7
Negative.
bad year.
Right.
So the good year goes away.
Yeah,
And
let
then we
me
still got the
give you a
bad
sense
year.
of this.
Now, everybody's assuming we're not going to have another good year.
But
I mean, if we get another 21% year,
It'll help.
it would help.
good luck with that. So
No
his
thank you.
job is to look at this and he's legally bound to give us the right information. And he gets to be the one that puts the data into the Gatsby, which is a federal requirement. Is that correct, Patricia?
Say again?
The Gatsby is a federal requirement?
Well, GASB is the Government Accounting Standards Board. It's not exactly federal, it's just the,
Who pays it?
I don't actually know who pays GASB,
You don't pay it,
No.
you just have to follow it.
but we do mandatorily have to
Yeah,
follow
GASB,
and
you have, the
adhere
auditors
to.
tell you have to submit
So-
governmental.
It's a national standard, I think.
It's a national,
It is national, but it's not a,
Like OSHA,
kind of, yeah.
Yeah, so it is from your perspective, kind of federal.
but the OSHA's under the,
federal government, but GASB's not under federal government, but,
Like the Fed Reserve, it's sort of their own little entity. and they
But-
put out all these generally accepted.
but the GASB requirements are, we mandatorily have to follow based on the Attorney General. So, and the audit general. So what happens is, at the state level, you have state legal requirements that require government entities to adhere to the government accounting standards boards. And it's just like non-government entities have to follow the Financial Accounting Standards Board, the FASB. So it's its own entity.
It's an independent private sector organization.
Yeah, it's its own entity, not affiliated with another government entity, but we do, by state law, and every single state in the United States requires government agencies to follow and adhere to the Government Accounting Standards Board,
okay, got it.
which is a convoluted way to say legally we have to, whether we want to or not. So that's what when we hire our auditors, our CPA firm to come in, they're following that. They're following the audit general. They're following the attorney general. They're following federal. They're following state laws. I mean, there's a lot of things that we have to, a lot of levels that we have to follow and adhere to, including Doug and Larry and Blake. We're all required to follow these regulations.
Lots of rules.
So, get enough information today?
Shirley, are you gonna come back?
Yes, I will.
I have a quick question.
Sure.
I understand it, but you're a perfect person to ask. I get a lot of employees asking me, how much does the city contribute on my behalf? And I understand it's not like that. How would you answer that?
Well,
I think maybe.
You know,
it depends. So last year,
To give you the divine benefit that you're promised when you retire under the current rules.
They're just
So-
asking in a simplistic.
so last year it was 9.19%. Last year it was 9.19%. For the upcoming, well, that's for this year's budget. The upcoming budget for fiscal year 24-25, that amount that the city's going to contribute on their behalf is 11.59. If you are in the police or fire pension, it's even higher.
You can tell them for general employee, it's like, remind them, hey, you're putting in 5% of your pay. Tell them the city's putting in more than double that.
Okay, that's a good, I'm looking for something simple like that.
That's it.
Because they all think, not all, you think, okay, we're doing 5, what are they doing?
And you can also tell them that their
They think
benefits
it's bottom
promise
line.
that whatever they accrue to any particular date and time can never, ever be taken away. There's no guarantee for the future. You don't want to let them think like nothing can ever happen, but you can tell them at any point in time, their benefit that they've accrued to that date is promised by law and can never be reduced. And by the way, the city's putting in a little more than double what you are.
I like that.
Yes, thank you.
And in the foreseeable future, that will be a true statement.
Yes.
Now,
And in a couple
if
years, you can tell them
Larry
it might
and
be about
Blake
triple.
get busy, maybe that number will come down.
We already figured it out, it's 2 years from now.
He's already given you good news for the current year so far, so.
If we annualize this quarter, we're gonna do 36%. What Blake said he could do.
You've already hit
Earn
the
us
assumption for the year.
36%?
Yep, you've already hit the 7 for the year and then
We
some.
could go to cash. if you want me to.
Wow, CDs, there you go. CDs from this point forward and you're done. All right, I'm done.
I did have one more question. I think I understand it. It was like 208,000 for vested employees?
Yes.
Does that mean they left and they weren't here 5 years, so that's what they got paid out, what, the 5%?
The 208,
Yes, I think.
yeah,
it was.
that number is the annual payments that we expect those who left vested but will draw at a later date.
Okay, all right.
We expect to pay them in total $208,000 a year,
All of those employees.
all combined.
A
They'll
year.
come in at different points in time to draw.
Okay.
That's where the 208 comes from.
Okay.
I make a motion to accept the actuary's report.
A second.
Thank you. That concludes new business. Informational item. Oh, we had a, we,
We didn't vote.
do we need to vote?
Yes.
Sorry. All those in favor, please say aye. Aye. Those opposed? Vote carries
Some
5-0.
things you can do by consensus,
Sorry,
like giving Larry direction, you know,
I'm new.
based on his advice. New, you've been here ever since I've been
I caught it.
in that seat.
Okay, I'll restate that. I'm young, still learning. Informational items, we already did discuss. Sterling Capital, they have attached, I think, to this, the press release. You have, Pam? Annual Financial Disclosure Form 1.0, yeah. So the disclosure Form 1 is, you're talking about the elected officials? That would,
It's done electronically now, so everybody knows.
so that's the elected officials and board members. We have to file a financial disclosure.
Did they have to do that?
Everyone has to do a
No.
F1.
You do.
But did they?
No, we do a Form,
Only
we do
you,
a
Skip.
Form 1.
You're the Form 6 guy.
I know.
They're all Form
I'm
1s.
putting that off as long
He's
as
Form
possible.
6.
Until they come to, with the news.
Who does one?
So you should be getting an email for the board members, except for the commissioner, should be getting an email from the city clerk about how to file your Form 1, and it's due, what, March 31st?
It's real simple compared to what.
It's a very simple form for us, that's just a financial disclosure. The state wants to make sure that we're not personally and appropriately gaining from our position on the board. Our commissioners, our elected officials have to file now a Form 6. It's much more informative.
Is that the one that's scaring everybody, or a lot of people away?
Yeah,
It is, because it's,
What?
the Form 6 is, for us, it's just listing.
Doing insider trading with people that you are known to do business with and give contracts to as your job as an elected official, and then you put down that you got $2.5 million in that company, it ain't gonna look good. Or 25,000, you know.
$2.5 in there, that's still frowned on.
For us, it's just basic, you know, they're just looking to see, is your income, your debt,
Yeah,
your
or head
assets,
over
do they
heels
make
upside down
sense?
in debt, you know.
It's not that invasive to us, but it kind of is to the elected officials now. And that's a new change for them. But for us, it's still the Form 1, it's not that bad.
You have to put everything that you.
We are,
own,
yeah.
Including household items that are worth over $1,000.
Do I know? So what was the last part you said?
Everything you own.
That we do or you
No,
do?
he does.
Commissioner,
Everything I own that's worth more than $1,000, I have to itemize.
Oh my gosh.
for us, it's much more simplistic. It's just, you know, what are your major debts? What's your major assets? It's not that big a deal.
You can get a paycheck from anybody, you get a pension from anybody.
And that's gonna be a public record for you
Yes.
Yes,
Yes.
guys. All out.
That's why
Yes.
people
Yes.
are quitting.
Right.
Yes.
Because they know they're gonna get caught. I haven't done it, because I don't worry, I've never even taken a campaign contribution.
We will see.
And the other thing is that previously we did those paper, we'd fill them out on paper and mail them in. Now the state is requiring they be done electronically, which is why you'll get the email from the city clerk she'll send you the link and get you set up so that you can do that electronically. It's not that bad for us. It still doesn't feel great, but it's not that bad.
See what you get?
Next quarterly meeting is May 16th, 2024, and we're adjourned.
Thank you.
Thank you.